Welcome to the Deep Dive from Talk Tickers. We're here to cut through the noise, really get to the heart of what's driving the companies you follow.
Exactly.
And today, we are zeroing in on nLIGHT Incorporation, specifically their first quarter 2025 performance and the outlook they gave on that recent call, May 8th.
That's the one. High power lasers, right? Mostly aerospace and defense, but they have that commercial piece too.
Right. And our mission today really is just to pull out the key insights for you, give you a quick, clear understanding of the results and, what's shaping their path forward.
Sounds good. We'll hit the main numbers first. But the real story is digging into the why behind them and what management's really signaling for the rest of 2025.
Okay, let's do it. So top line numbers for Q1. How did nLIGHT actually perform?
Overall, pretty solid. Definitely better than they guided for. Total revenue landed at $51.7 million.
Okay, $51.7 million. And how does that stack up against last year?
Well, compare that to Q1 2024, which was $44.5 million. So you're looking at, 16% growth year over year? Healthy.
16%. Yeah, that's not bad at all.
Yeah.
And I saw their profitability metrics. They also looked pretty strong. Came in above guidance.
Exactly. Both the total gross margin and the adjusted EBITDA were above the high end of their own guidance range, which is always good to see.
Right.
And adjusted EBITDA, this is interesting. It was actually positive this quarter. Only $116,000, but positive.
Wow, okay. Compared to last year.
Huge difference. Last year, Q1, they had an adjusted EBITDA loss of $4.9 million. So quite a significant turnaround there.
That's a big step getting into positive territory.
Yeah.
And the bottom line, the GAAP net loss.
That narrowed too, down to $8.1 million or 16 cents per share. Last year, it was a $13.8 million loss, 29 cents a share. So definitely moving in the right direction, chipping away at that loss.
Okay, so clear progress on profitability. But what was really driving these better than expected numbers? What was the engine here?
Yeah, this is where it gets really interesting and very focused. The outperformance. It was overwhelmingly driven by their Aerospace and Defense segment, A&D.
Okay, so defense was the star. How strong was it?
Really strong. A&D revenue surged. Get this. 50.4% year over year, reached $32.7 million.
50%. Wow.
Yeah. And it was also up sequentially about 8.6% from Q4. So good momentum there.
Okay, 50% year over year growth in A&D is huge. And didn't they specifically call out defense product sales within that A&D number?
They did, and that's really the core insight here. Defense product sales were the absolute standout. They jumped more than 150% compared to Q1 last year.
150%?
Yeah.
Okay, that's not just growth, that's explosive.
It signals that some of these major defense programs are really hitting their stride, moving from, development work into actual production shipments at volume. That's a key transition.
Right, so which specific programs did they mention as driving that incredible product growth?
They pointed directly to shipments of critical components for that big $171 million Helios II program.
Oh, the directed energy laser one.
That's it. And that's a really substantial program for them. And they made it clear they expect it to be a major contributor throughout the rest of this year.
Okay. And they also mentioned the Army's Dem Shore Ad program.
Yep, Dem Shore Ad. That's the 50 kilowatt high energy laser for short range air defense. Work there is progressing well, expected to wrap up around mid-year.
So these programs really highlight nLIGHT's position, don't they? That whole vertically integrated thing they talk about.
Absolutely. They really emphasize that point, controlling the tech stack from the laser chips all the way up to the full systems, and critically supported by U.S. manufacturing.
Which is huge right now. That vertical integration, the domestic production.
Yeah.
It aligns perfectly with what the DoD is prioritizing, doesn't it? Things like directed energy, laser sensing.
Yeah, exactly. And they talked about why directed energy is so critical. It complements traditional missile defenses, offers, advantages like a deep magazine.
Basically unlimited shots, right?
Yeah.
As long as you have power.
Precisely. Low cost per engagement compared to firing expensive interceptors, and just pure speed of light engagement. They can neutralize threats like drones, rockets, mortars, even some missiles. It fundamentally changes the economics of defense.
And it's not just directed energy. Their laser sensing products are key too.
Right. Things like missile guidance, proximity detection, range finding, countermeasures. These are incorporated into major existing defense programs. It's a broad portfolio.
And it sounds like interest is picking up both here and overseas.
Definitely. Domestically, they mentioned they're actively responding to RFPs and RFQs linked to the president's Golden Dome executive order.
Golden Dome. Remind me, what's the focus there?
Golden Dome is all about speeding up the development and deployment of non-kinetic defense systems, especially against missiles, and crucially, emphasizing U.S.-made capabilities.
Ah, okay. So with their U.S. manufacturing footprint.
They feel they're exceptionally well positioned for opportunities coming out of Golden Dome, potentially starting to hit in the next few years.
Makes sense. And internationally, you mentioned Iron Beam.
Yeah, their work on the Israeli Iron Beam system, another big directed energy project, that's progressing. And beyond that, they just talked about a growing pipeline of new international opportunities they're starting to pursue.
They also seem pretty positive about some classified programs opening doors in laser sensing.
Yeah.
And mentioned something called Golden Dome.
Right. They noted early success on some classified work is leading to more and bigger pipeline opportunities in laser sensing. And yeah, Golden Dome sounds like another sensitive initiative, probably leveraging their tech. The fact they mentioned potential contributions from it in 2026 and beyond suggests it could be significant long term.
Interesting. So putting it all together, strong Q1 in defense, Helios II ramping, Dem Shore Ad progressing, Golden Dome, Iron Beam, pipeline growth.
It all led them to reiterate their forecast for A&D revenue to grow by at least 25% in 2025. And they explicitly said they have increased confidence in hitting that.
That, at least, and increased confidence definitely stands out, especially given the wider economic uncertainties. Okay, so that's the strong A&D picture. Let's flip to the other side, commercial markets. Industrial microfabrication, how's that looking?
Still challenging. That was the clear message. It remains tough overall.
But they did see a little sequential improvement in Q1, up, what, almost 10%?
Yes, 9.9% sequentially. But the context there is important. That was primarily driven by microfabrication sales.
And why was that?
Management basically attributed it to operations getting back to normal at their contract manufacturing partner in Thailand. That allowed them to finally ship out products that customers had ordered before, but they couldn't fulfill due to those earlier disruptions.
Okay, so it was more about clearing out old backlog, not necessarily a sign of fresh demand picking up.
Exactly what they implied. They were pretty explicit, actually, saying overall demand in commercial markets is expected to stay weak for the rest of the year. So that Q1 sequential bump looks more like a temporary catch-up.
Got it. Still weak on the commercial front overall. Did they mention anything longer term there? Additive manufacturing?
They did touch on longer-term optimism for metal additive manufacturing, particularly how their laser tech fits into A&D needs things like faster prototyping, building more resilient domestic supply chains.
So kind of leaning back into their defense strength even for that longer-term commercial opportunity.
Seems like it. Now, something else that weaves through both sides, but especially commercial, is tariffs. This came up quite a bit.
Right. A lot of uncertainty there. How are they thinking about it?
They acknowledged it's complex, lots of debate, hard to predict the impact on the economy, demand, their own costs. They've spent time modeling scenarios.
How does it hit the defense business? That seems somewhat insulated.
Largely, yes. They said they do not expect a significant long-term impact on defense. Maybe some short-term margin bumps up or down on certain defense products if tariffs hit imported materials they use.
But not on demand or overall profitability long-term for defense.
That's what they said. The nature of government contracting provides some buffers there.
Okay. And the commercial side, they've already made some moves there, haven't they?
They have. They shut down their Shanghai facility late last year, remember, and shifted that commercial laser production to their U.S. facility and that Thai contract partner.
Right. So that gives them flexibility to manage tariff risk.
Exactly. It's a key mitigation strategy for the commercial business. Their CFO added some more detail in the Q&A, too.
Yeah, what did they say about specific impacts?
They pinpointed the industrial fiber laser business as the most affected, mainly because of input costs from China. Q2 probably won't see a big hit because they have inventory on hand.
Not later in the year.
Q3 and Q4 could see some margin pressure if the tariffs stick. They estimated maybe around a couple hundred basis points, so like 2 percentage points.
Okay, so potentially a 2% hit to margins on that specific business.
Yeah.
Seems manageable, but nothing. What about broader indirect effects?
That seemed to be a bigger worry for them. The potential indirect hit from high tariffs slowing down the broader economy, hurting overall commercial demand, that's much harder to forecast.
But the defense business is more insulated from that broader economic slowdown, too.
Relatively speaking, yes. That was the message.
And what can they actually do to fight back against these tariff impacts?
Well, they mentioned trying to pass costs on where they can, using those production shifts we talked about, and maybe leveraging some specific regulatory angles in the A&D market. But the overall uncertainty is why they slightly widened out their gross margin guidance range for Q2, just building in a bit more room for variability.
Okay, let's dive back into the Q1 financials a bit more. We know total revenue was $51.7 million. How did that break down between product and development?
Product revenue was the larger piece, $35.7 million, and that was up a strong 21.5% year over year.
Driven by that huge defense product growth we talked about.
Exactly. That surge in defense products more than made up for the decline they saw on the commercial product side. Development revenue was $16 million, up a more modest 5.4% year over year.
Got it. And gross margins. We know they were better than guided, but there was that duty reclaim thing.
Right. Total GM hit 26.7%, which looks like a massive jump from 16.8% last year. But yeah, they called out a specific $1.9 million benefit from reclaiming duties in Q1.
How much did that impact the margin?
They said it was roughly 500 basis points, so a full 5 percentage points of that GM came from the reclaim. They'll keep trying to reclaim duties, but don't expect it at that level every quarter.
Okay, so if you strip that out, what was the underlying margin picture?
Backing that out, you get a normalized Q1 GM somewhere around 23%, still significantly above their guidance range. So even without that one-time boost, the underlying performance was strong, likely due to better operational efficiency and that favorable mix shift towards higher margin A&D products.
Makes sense. And product GM specifically, was that also strong underneath?
Very strong, 33.5% for product GM, way up from 20.9% last year. That got help from higher volumes absorbing costs, the better A&D mix, and that duty reclaim. Development GM was 11.5%, up from 8.9%, but they said that was mainly due to program mix, and they still expect it to settle back closer to 8% going forward.
Okay. How about operating expenses? Did they keep costs in check?
OpEx did tick up slightly. GAAP OpEx went from $22.2 million last year to $23.4 million this Q1. Non-GAAP OpEx also edged up a bit, from $17.2 million to $17.8 million. So costs are creeping up, but not dramatically.
All right, let's shift to the balance sheet and cash flow. I noticed they drew down on their line of credit.
Yeah, that caught my eye too. They ended Q1 with $17 million in cash and equivalents, restricted cash, and investments. And during the quarter, they pulled down $20 million from their $40 million line of credit facility.
Why did they do that? Were they burning cash?
Management framed it as a prudent move, putting a cash buffer in place. They cited two main reasons. Ongoing uncertainty around tariffs, sure, but more significantly, they expect increased working capital needs.
Why increase working capital?
To support the big growth ramp they see coming in the A&D markets, especially in the second half of the year. Basically, they need cash to buy materials, build inventory, and cover costs before they get paid by customers for those bigger defense shipments.
So it's funding expected growth, not covering losses. That ties into the inventory build too, right?
Exactly. Inventory increased to $43.8 million, up from $40.8 million at the end of last year. And they specifically said this increase is primarily to support that forecasted ramp in directed energy products later this year.
Did they give any sense of how much cash they feel they need overall?
They mentioned sort of an internal benchmark of thinking about being adequately capitalized around $100 million total, but quickly added there's no magic number. It's about having enough to fund working capital and necessary CapEx for growth.
Okay, clear link between the cash draw, inventory build, and expected second half ramp in defense. Let's look ahead then. What's the guidance for Q2?
For Q2, they're guiding revenue between $53 million and $59 million. Midpoint there is $56 million.
Okay, $56 million midpoint. How does that break down?
At the midpoint, they expect about $38 million in product revenue and $18 million in development revenue.
And crucially, they expect A&D revenue to keep climbing in Q2, both sequentially and year over year.
Yes, they explicitly guided for continued A&D strength into Q2. But on the flip side, they also reiterated that the weakness in commercial markets, industrial, and microfab is expected to persist throughout the rest of the year.
Right, so the divergence continues. What about Q2 gross margin guidance?
Product GM is guided between 27% and 33%. Development GM around 8%. That nets out to a total GM range of 19% to 25%.
Wider range there, reflecting maybe that tariff uncertainty and volume dependency.
Seems likely. They noted GM really hinges on production volumes and absorbing those fixed manufacturing costs, plus the trade uncertainty.
And adjusted EBITDA for Q2, still aiming for break even.
The Q2 guidance range for adjusted EBITDA is approximately $94 million to positive $1 million, so the midpoint is still slightly negative. They did reiterate their view that break-even adjusted EBITDA happens somewhere in the $55 million to $60 million quarterly revenue range.
Which they could hit at the high end of Q2 guidance. And very importantly, they confirmed the plan still assumes the second half of 2025 will be stronger than the first half.
Yes. That assumption remains key. It lines up perfectly with the inventory build, the LOC draw. Everything points to them positioning for a significant step up in activity, presumably defense-led, later in the year.
Did the Q&A shed any more light on key topics?
It did add some useful color. On A&D visibility beyond Q2, they tied it clearly to executing on programs like LC2, plus converting that growing pipeline of opportunities into actual orders.
And they reconfirmed the weak commercial outlook for the full year. Still down.
Yep, confirmed no real change there. Still anticipated decline for the full year, probably in that 15-20% down range they mentioned previously. That side just isn't recovering yet.
Any more on tariffs from the Q&A?
Just reinforcing the main points. Industrial fiber lasers are the most directly hit due to China inputs, potential Q3, Q4 margin impact there, and mitigation efforts like pass-throughs and production shifts. They also briefly addressed potential secondary exposure through suppliers, especially for A&D parts, but felt their direct exposure there was limited.
And the line of credit draw any pushback on why?
They reiterated it was about funding the working capital needed for the second half growth ramp, not because of any government customer demanding a stronger balance sheet or anything like that, purely operational growth funding.
Anything else interesting? Additive manufacturing.
Backlog.
Briefly on additive, they mentioned focusing on U.S. and European customers where growth might be a bit slower currently than other regions. Suggests it's still early days. On backlog, no specific numbers given quarter over quarter, but management said they felt levels were appropriate and proposal activity is increasing. They sounded pretty satisfied with the defense business trajectory.
Okay, so that brings us to our speculative segment here at Talk Tickers. Time for the "this is not financial advice" trade idea. Strictly illustrative, just playing with the themes from the call.
Right. Purely a thought experiment based only on what we heard. So let's recap the key threads. You've got explosive defense product growth driving results, led by programs like Helios II. You have management setting increasingly confident about at least 25% A&D growth for the year, despite the ongoing commercial weakness. And you have clear actions, the inventory build, the credit line draws, signaling they're gearing up for a significant second half defense ramp. Plus, you have some tariff noise that might create bumps.
Okay, so here's a potential high conviction, high leverage pitch framed like you're talking to a speculative investment committee. Look, the commercial weakness, the tariff worries, that's just noise right now. It's a distraction from the real story.
Which is
an accelerating multi-year defense ramp. This isn't speculative hope. It's driven by concrete DoD priorities in non-kinetic defense-directed energy, laser sensing. Stuff like Helios II is real, Golden Dome is coming, Iron Beam is progressing, and nLIGHT's U.S. manufacturing fits perfectly. The inventory build, the cash draw, that's management betting on this ramp happening, likely driven by LC2 shipments and new wins from that growing pipeline. They're putting money behind that expectation.
Okay, so if that's the conviction narrative, what's this illustrative trade idea? Acknowledging extreme risk, of course.
The aggressive play, purely based on this narrative, buy out-of-the-money call options, target expirations later this year, maybe even into early 2026, say January 2026 calls. Strike prices significantly above where the stock is trading now.
Why calls? Why out of the money?
Because you're making a leveraged bet that the at least 25% A&D growth is actually conservative. You're betting the market hasn't fully priced in the acceleration and magnitude of this defense product ramp and the potential for more big wins. You think the market will eventually be forced to re-rate the stock based purely on this defense story, overwhelming the commercial drag and tariff hiccups?
So it's a pure directional bet on the core A&D momentum being bigger and faster than expected. High potential return if you're right.
But also a very high probability of losing the entire investment if that aggressive move doesn't materialize in the time frame of the options. It's leveraging up on that specific defense thesis. Again, purely illustrative, high risk, not financial advice.
Understood. Okay, let's wrap up this deep dive on nLIGHT's earnings call. What's the single biggest takeaway?
I think it has to be the robust performance and, more importantly, the increasingly confident outlook for their aerospace and defense business. That explosive defense product growth tied to these critical directed energy and laser sensing programs aligned with national priorities. That's the engine right now.
And that engine is strong enough, for now at least, to compensate for the acknowledged and ongoing weakness in their commercial markets. They seem to be navigating the tariff uncertainty and other macro issues with strategic moves in manufacturing and on the balance sheet, specifically to fuel that expected A&D growth.
Exactly. And just to reiterate one last time, everything we've discussed is for informational purposes only. It is absolutely not financial advice. Investing carries significant risks. Always do your own research.
Okay, so a final thought for you, the listener, to chew on. Considering the global security situation, the clear focus on new defense tech like directed energy, and the push for resilient domestic supply chains, how sustainable could this defense-driven growth be for a company like nLIGHT with its specific positioning? And maybe the bigger question, how quickly could those pipeline opportunities they keep mentioning turn into actual material revenue upside that surprises beyond their current guidance? Something to think about.